Hello, folks. Welcome to the Weekend Investing Daily Bite of 2nd of April. A decent day, I would say. Yesterday, the market made a fool of the bulls. First April was April Fool's Day. But today, the market was reasonably stable. Tonight is the action, rather early morning India time is the action, where 6 a.m. India time Trump will speak and the world will listen. There's one man who is going to, change the lives of 8 billion people, and that's the power of the US presidency. So today we are going to discuss and see what happened in the 70s. There's a lot of talk about the current period looking like the 1970s. And are we going to see a replay of the dangerous 70s, as they say? We'll go through a lot of data from that period and see where we are fitting in that framework in the second half of the video. Of course, please do read the disclaimer fully. If you are not agreeable with the disclaimer, please stop the video right now. But if you are okay to go ahead, please subscribe to the channel and let's go forward. Where is the market headed? So markets recovered 0.72% on the Nifty. I would say there is a very big silver lining in the market right now. All kinds of naysayers are there in the market that the market cannot go up. Markets always climbs walls of worry. And whenever markets will go up, people will keep wondering for a long period of time why the markets are going up, because people want to know that why, and the market doesn't care about the why, at least not till it's too late for most people. So the right shoulder that I've been talking about, this is the inverted head and shoulders potential pattern. The right shoulder still has this much ground to cover, and if that ground is covered and we do break through here, I can tell you a lot of people are going to get surprised if that happens. On the downside, below 23,000 is something that I am not, expecting now. Of course, I will reserve my right to be wrong, and this is pure speculation that I'm doing. But to me, the undercurrent looks stronger than what the narrative is in terms of despondency in the market. Even today, many veteran market analysts, managers, investment managers are talking a lot of warnings and stuff like that. I'm not so sure about that, but that's okay. Nifty Junior almost entirely covering yesterday's loss at 1.15% gain. This is telling you the strength of the current move. Mid caps 1.4%. We are at yesterday's high, not just yesterday's close. We are at yesterday's high. So we've actually covered the last two sessions of downfalls loss, and we've closed at near the high of the day. It is telling you something. 1.4% on the mid caps. Small caps are 1%. Here again, we've covered the last 2 days of loss and closed very nicely at plus 1%. Very nice recovery on small caps today. You can see it almost took a support exactly at the 40 DMA, just like it did 3 days back. So from charts perspective, I see a lot of silver lining that is possible. Bank Nifty also has recovered about 1%. Bank Nifty, of course, earlier had gone up from below 48,000 to 52,000. So that was almost like a 9% kind of a move. And we're still very near in that vicinity. So it is telling you that the market is not giving up on this gain. Otherwise, you would have seen that we would have been here at least. But that's not happened. Gold going up every day virtually, another 0.5%, conquered 91,000 plus is where gold is. Naysayers will keep saying that it's going to crash and it's going to do this and that, but never argue with a bull rally. The bull rally broke out at 88,000 here, took a support, came back, retested this breakout and has gone up. That's a very good chart formation. Only below 88,000 do you really need to get worried now. Until then, this is a strong bull rally. It is a buy on dips till then. Market breadth. Market breadth is 2nd April. We are at 382 versus 118 declines. Very good market breadth. In fact, the best in the last 5 sessions. That is also telling you a lot about the market. HDFC Bank recovering after yesterday's drubbing, 1.6%. Infosys also up 1.5%. Tech Mahindra, Maruti, Titan, Bharti, Zomato. Zomato coming up 5% after its inclusion in the Nifty. Today, Tata Consumers up 7%, and some sporadic gains in ICICI Bank and State Bank of India along with ONGC. So good day. Only Bharat Electronics really losing more than 3% here. In the Nifty next 50 space, again it is awash with green. Bajaj Holding, ABB, ICICI Pruli, Chola Finance, some of the stocks that lost some ground, but DLF came back very, very strong. 3% here, DMart nearly 3%, PFC, Lodha up 5%. Very strong moves in some of the counters. Britannia, after moving out of Nifty, up 3%. TVS Motors, Indian Hotel, all doing quite well. Sectoral trends. Today's sectoral trends: real estate made a sharp move of 3.6%. Capital markets made a sharp move of 2.2%. Tourism stocks up 2%. And consumption stocks at 1.6%. These were the big leaders. What was losing was CPSE mildly down at minus 0.4%, and defense stocks mildly down at minus 0.1%. No major losses as such. If we see over a month, let's say, we see defense have gone up 23% in just 1 month. Public sector enterprise stocks and PSU banks are up 16 and 12%. Energy is up 12%. So you can see the mix that has changed in the last 1 month. If you will see 6 months picture, you will find that defense was down, uh, energy was down in a big way, FMCG was down, but now autos also down 21%, real estate down 22%. So this last 1 month has been very, very different from the last 6 month trend, and sporadic changes have happened in the mix of which sector is moving forward. For more on this, you should watch the weekly review, where we do a matrix of uh, momentum scores of different sectors. That weekly review is very, very important. Don't miss that. It is out every week on Saturday noon. Real estate coming back 3.6%. Macro tech, which is Lodha, Godrej Properties, Prestige, DLF, Oberoi's, all doing very well, 3% and more. And that brings us to the topic of discussion for the day. Are we going to see a replay of the dangerous 70s? Most of you were born in the 90s, I presume. The age bracket that YouTube shows me of the viewers is, on average, about 80% of the viewers are 25 to 40-year old. So most of you are born after 1985, and you would probably not have seen real, you can say, uh, economics impacting your life, let's say, in the previous century. Only once you were in the workforce beyond 2004 onwards did you really see the markets. And beyond 2004 onwards, minus the GFC and the COVID, there has not been any major, you know, fiasco that has happened in the market. So that experience of the last, you can say, 20 years is not so bad. But if you go down, 30, 40, 50 years behind that, you will find that markets were of a different nature. And the current market setup is almost looking like that nature now. And we'll go through some of the charts. So the sort of basis for this today's idea of doing this came from a quote from Rick Rule. Rick Rule is a very renowned commodities analyst, and he runs the Sprott ETF. And I believe a replay of the 70s in the financial sense is inevitable. He says you need to look at what worked in the 70s during a period where the US dollar lost 75% of its purchasing power. The gold price increased 30-fold. So that's his outlook on gold and purchasing power of US dollar. But let's see what actually happened. So this is going to open a lot of brain cells for a lot of folks, because you would have never thought of it that this could have happened to the market in a 10-year period. So let's start from the 1970s. It was a tumultuous decade economically, often cited for one of the rare instances of stagflation, combination of stagnant economic growth plus high inflation plus high unemployment. So this, troika combination of growth stagnating, inflation going higher, and high employment happening, that creates something what's called stagflation. And we are seeing echoes of the same in today's world. So US economy in the 1970s, inflation averaged over 7% across that decade. Can you imagine that for the US? Unemployment remained high. Oil shocks, 1973 and 1979, triggered economic energy crisis. US abandoned the gold standard in 1971, so USD lost credibility there. And Fed funds rate went from 4% to 20% by 1980. Is it even imaginable today that US interest rates can go from 4% to 20% within 10 years? We are so accustomed to low interest rates of the last 40 years that we have forgotten that interest rates can go higher also. It is exactly the same phenomena of recency bias that happens where, when you are in a bull market for 4 years, you forget that the market can come down also, and the vice versa. When markets are down, like right now, just 6 months have gone by, markets have gone down, and nobody is willing to believe that markets will go up. That happens to our, human mind when we see trends in that direction for long periods of time. So let's look at some charts, because there is no other better way of understanding things other than looking at chart, because everything else is just narrative, but charts are showing you, real data which you should be believing. So the deadly 70s, the S&P 500. What did the S&P 500 do? So from 1942, post the World War, 1942 to 1968, this period saw S&P gain 10% CAGR in 26 years. But then started the 1970s, where for almost 14 years, the S&P 500 did not make any returns. Just imagine this: for 14 years, the American market did not make returns. Yes, some dividends probably here or there, but 14 years, no capital gains on S&P 500. And what happened during those 14 years? There were four major corrections: 36% correction 1969 onwards, 73 onwards 50% correction, another 20% correction, another 28% correction. So imagine if you started your market journey as a young man in 1969, you came into the workforce. For the next 14 years, you virtually did not make money. So in that period, your confidence in the market will go for a toss, that yes, markets is not for making money. For 14 years, if you stay in the market and you make nothing, your confidence will go bust. So exactly at 1971, what was that historic moment that happened at this point is that President Nixon on August 15, 1971, ended the Bretton Woods Agreement, where he said that the dollar is no longer backed by gold, and you cannot exchange the US dollars with gold anymore. So a lot of countries which were holding dollars were then, from that point onwards, unable to convert their dollars for gold. And this allowed the Federal Reserve to print as much money as they wanted, because now they need not have put a backing of gold to the dollar. So this decision, and then later the Plaza Accord that happened in, I think, 1975, that set the stage for high inflation, dollar getting devalued, and other currencies going up. So you can see this chart of gold. This is a 100-year chart of gold. So gold was held at, $32 all through, and then, the end of the Bretton Woods system happened. The gold was set free. Uh, you know, just like that Ja Simran Ja meme is there for that movie. That, gold was set free. That you are we are setting gold free. Go and find your price. And gold moved from $32 to $800 within a span of a decade. The move here, the gold CAGR was 31% in that decade. Can you believe that? 31% CAGR in dollar terms in gold. And the move in S&P 500 was virtually nothing. The entire decade was spent with just 35% of gain from January 70 to January 80, while gold made a 1800% move in the 70s. It sounds unbelievable, but it actually happened, right? And there is no way to say that this cannot happen again. Neither am I suggesting this will happen, neither am I suggesting that this will not happen. I am suggesting that this has happened in the past, the history is there, it can happen again. That's all. Oil in the 1970s. So there were two major oil shocks in the 1970s. 1973 oil embargo, where OPEC countries cut oil supply in response to US support for Israel. And almost overnight, oil went up four times. Can you even imagine that today? That oil goes from $70 to, four times. 200 to 280 dollars. I can't even imagine it. 1979 Iranian revolution disrupted oil supply, and there was another spike. So there were a lot of fuel shortages, skyrocketing transportation, and inflation occurred. So this is the oil chart. Oil rose at 25% CAGR during the 1970s. So oil was at, I don't know, $3 or $4 per barrel, and it reached $39 per barrel within the same decade. Imagine 2025 today, and 2035 oil goes up 4x. It's difficult to imagine that, right? What happened to inflation? Inflation obviously spirals out of control, because there's free flow printing of dollars. You don't need to back up with gold anymore. Uh, there is a oil spike shock. that is happening, which is fueling the inflation. So inflation hovered 6 to 7% for most of the decade, and it peaked at 13.5% in 1980 in the US in dollar terms. This was driven by oil prices, loose monetary policy, and a lot of spending on social programs, Vietnam War spending, and so on and so forth. Consumer purchasing power deteriorated sharply, and everyday essentials became more expensive, which is what is sort of beginning to happen in the world over. What happened to inflation? So you can see in 1970s, inflation was nearly 4 or 5%, and then there was a very sharp deflationary move once gold was set free, and then the inflation really spiked high when they had to print out of nowhere, and inflation went to nearly 11%, and they were aftershocks of that wave that happened, and by 1980 we were still at 10% inflation right there. So interest rates, to combat the spiraling inflation in the 70s, Fed started to hike interest rates. I mean, you very well know that whenever inflation goes out of control, the only tool that the central bank has, or the Fed or the Reserve Bank of India in our case has, is to increase inflation to cool down the economy. So Paul Walker, he was the Fed chair from 1979. He said, let the interest rate go to the moon. And from 4.4 to 5% Fed funds rate, it reached 10% by 1978 and 20% in 1980-81. That's the kind of interest rate move that had to happen to control inflation. This is that spike where 1970, you can see there was one spike from 4% to 12%. It then again cooled off, and then it went from 4% to nearly 18-20%, and then it took another 30 years to cool off. So in the current scenario, I would say we are somewhere around here. If one were to equate that situation with us, that there has been an interest rate spike. Fed funds rate went from quarter percent to nearly 5+%, and now we are cooling off. We are right here, and this next wave upward is expected going forward. So long term chart of oil, if we want to see, this actually determined the major shift of oil, which had been nearly $2-3 per barrel, and then there was a decade of shift, and then it went flattish again. Post that, there has been only so much of a change. So this oil has been, and that this is my personal view, of course, oil has been nearly $70 since 2008 or 2006 actually. Just imagine, there is a commodity out there which for 20 years has not changed, while the money base has gone from where to where, everything has gone up, but crude oil has not gone up. This kind of a decadal move, these kind of moves are going to come from time to time, and crude oil is actually sitting at the cusp of that. I don't know what happens to India's import bill if that happens. Interest rates. Interest rates, the spike happened during this decade. You can see they were sitting pretty at 4%, and then it went to 18%. So from 1982 onwards till just last year, we have only seen interest rates come down. Can you imagine that? 42 years of interest rates just coming down, 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 down. So what happens? Everybody is convinced in their minds, because for two generations, people have not seen interest rates go up, that interest rates have to go down. And when interest rates have to go down, bonds have to go up. General maths. Now, that equation, is it changing? Are interest rates into this cycle now? They've seen this cycle. Now, are we into this cycle? This is probably the first bump that we've already seen here, like this. Are we going to see another spike, then another spike, big one? And what is going to happen for the bonds? If that decade were to happen, bonds will get crushed, and such a big bond market is there world over. People are sitting with trillions of dollars of bonds will get crushed if interest rates have to go up. Interest rates will not be allowed to go up, because the governments can't afford higher interest rates, because they also have to pay interest on the debts that they have raised. 130% debt to GDP for the US, they cannot afford it. So what will happen? They will have to artificially reduce the interest rate. How they will do that? By flooding the market with money. So money printing will have to go berserk, so that interest rates remain low. It's a very, very tough situation. What happened to gold during that spike? Gold went from $32 to $800. Will that spike happen again, or are we already in that move up? I don't know, but it's very much possible. You can't rule that out basically. What does the S&P chart look like for the very long term? This is the last 75 years of data. You can see that for that decade, we didn't go anywhere. Yes, it has been fine before and after that. But for that decade, we didn't do well. And there was another decade here, there, where the market didn't do any new gains for almost 10 years. So don't assume that the market has to go up every year in the US. And hence, also corollary to Indian investors, don't assume that the market has to go up every year, every 2 years, every 3 years. We may also get a period like this. So nothing can be, assumed going forward. Are we going to see a repeat of 1970s? There are, in my view, many signs, many clues that are there, but who knows, right? I mean, how this one global leader that we have is going to move the whole world. So it's better to be prepared than to be surprised if this happens or one of these things happen, because each of them is a time bomb. Whether oil going up, whether gold going up, whether interest rates spiking, whether inflation going up, each of them is a separate time bomb which are basically connected to each other. So one goes off, the other has to go off. Sort of that kind of situation is there. So we have to be better prepared. We have to consider all these outcomes before it happens. What if, why do we take life insurance? What if I'm not there anymore? My family will get taken care of, right? This is the same question. What if this happens? What will happen to my financial portfolio? So better to be prepared with solid asset allocation to tackle any situation in the market. What is your take on this subject? I'll be very happy to read your comments. Do comment. I know there are so many deep thinkers out there, and Weekend Investing is blessed to have followers who can really think deep and write good comments. Do write your comments. It will be great to chat there. And do you think that we will see a repeat of the dangerous 70s? That is a question you need to answer. Thank you so much for watching. Do like and share this video if you think this is of any worth, and do subscribe to our channel. Thanks. Bye.